So let's make sure. Let's make sure we're all hooked up here. All right, so let's look at indirect tax today. In essence, all an indirect tax is that they're going to give you a supply and a demand curve, or they're going to ask you to draw one. And they're going to want you to find a few things first. They're going to want you to know, and you should always know, how to find the price at equilibrium, the quantity at equilibrium, right? Know where consumer surplus is, know where producer surplus is, right? Those things are just slightly where we're going to start. And we're going to get rid of those, even though we know we have to know where they are. They're going to make this a little sloppy if we don't get rid of them. So, easy enough. Now, understand that they're going to give you a tax on a good. They're just going to say there's a $2 tax, a per unit tax. They could say this is going to shift supply to the left. We'll call it S plus tax. This is the supply curve after the tax. It's shifted to the left. There's a new price that the buyer would put in here or would have to pay. There's a new quantity due to the tax, right? Let's call it QT or Q tax. We can recognize, and we should, that this triangle right here, remember all of that used to be consumer surplus, all of this used to be producer surplus, but now society has lost some of this good. There's been what we call, and sometimes we should have a good definition of deadweight loss in our head. Deadweight loss is a loss of consumer surplus and producer surplus. In essence, before, that amount of that was consumer and this amount was producer. Now, due to society not getting that amount of the good, they've lost this quantity due to those taxes. There's been a loss of consumer and producer surplus. That is what deadweight loss is. It's a loss of quantity that society would have gotten before the tax. They would have gotten QE, now they only get Q tax, so they've lost some consumer and producer surplus. We can also talk about this as they've lost some total welfare being benefit to society, right? We think more goods are better than less goods. I spelled that wrong, that's okay. Loss of total welfare. We could also call it a loss of total surplus. And you need to know all of these phrases because they like to ask this. If it's unfamiliar to you, you'll be a little confused. Total surplus is obviously just consumer and producer surplus together. So we need to know that about deadweight loss. We always need to be able to find it with an indirect tax. We need to recognize that consumer surplus can be defined, or at least being able to identify it, is the area above the price but below the demand curve. So this is our new price that the buyer pays right there. Everything above that is consumer surplus. Everything below demand, this whole area, that triangle, is our new consumer surplus. We can see that it shrank after the tax. Obviously, everything below, or maybe not obviously, let's just write it out. Producer surplus is everything below the price and everything above the supply curve. Remember, supply is their costs, right? So everything above they can make above their costs is surplus, or we could say it's some kind of gain here, monetary gain, right? Nice. Consumer surplus, producer surplus after the tax. Again, we're going to get rid of these. Do we need to know them? Yeah, they're going to want you to know where those things are. And if we do these the same way again and again, there's only about 6, 7 of these, I think. Lots of them are very similar to each other. Once you do about 4 or 5 FRQs, and that's the best place to start for understanding indirect taxes, is do 4 or 5 of these FRQs, and then you will have a clear understanding how they like to ask this. They can get a little tricky on the multiple choice questions, but the FRQs are fairly straightforward. So we should recognize that the vertical distance anywhere between these two curves gives us the amount of the tax. So that vertical distance from the price there, we're going to go straight down until we hit that lower supply curve right there, and we're going to bounce right to the left. If that's the amount of the tax, that vertical distance there is the tax, then this should make sense. If the buyer pays a certain amount, then the tax is separated or subtracted. I have a brain fart there. The tax is going to be subtracted from that $13 that I take in for the good or whatever the price is. I subtract the $2 tax, and what's left over is what goes in the seller's pocket. This would be what the seller receives, is that amount right there, that price. This is the price the buyer pays. This whole rectangle here is what we could call the tax wedge. This is all that going to go to the government. We could call it government revenue, the tax wedge. That rectangle is how we would calculate how much would go to the government, right? Make sure you know about that new consumer surplus and producer surplus. Be able to find the buyer's price, know where the new quantity is, and how much the seller would receive, put in his pocket. Taxes imposed, that you need to know that vertical distance between the two curves is the amount of the tax. They won't always tell you it's a $2 tax. Sometimes you're going to have to just recognize that vertical distance is what gives us our amount of our tax. All right. And then who pays the tax, right? There's a way to do this, which I think sometimes gets skipped over, but you should know it. If we go to our old equilibrium point and we draw a line straight across, ooh, I hate that color, colorblind, and that's just terrible. So let's try this one. We go to our old equilibrium point, we go straight across. What we can recognize is this tax wedge shows not only what the consumers would pay of the tax, but also what producers would pay of the tax. This would be the tax part that the consumer would pay, and this would be the tax part that the producer would pay. Now, think about that for just a second. The producer would love to charge the whole $2 to the consumer. He would love to raise the price by the whole $2. But he can't do it due to the elasticity of demand. If he raises the price too much, people are going to walk away from it and not buy it, and therefore he would lose revenue. So in some situations, most situations, they have to kind of split the tax. The consumer is going to pay some of it, producer is going to pay the other part. Now, again, the way you find that is you go to the old equilibrium point, and all you got to do is draw a line straight across, and you can kind of see that area of consumer and producer tax being paid, or tax incidence, like they call it. Okay, and obviously we could calculate that area too if we needed to. Let's go ahead and do number 2005 here. That's kind of like an overview. You should be able to draw your own graphs, know those things, label them, know where they all are, see them, do it 5, 6, 7, 8, 9, 10 times. And you can kind of put this section to bed. I mean, there's obviously little tiny pieces that are annoying that we kind of have to know, and the more we do them, the better we get. But this is kind of something where if you're challenging yourself right before a test, you should be able just to draw this all out. And could you come up with all of that in your head? Maybe. All right, let's just do this one. Number 2, 2005. I have also done this other places, but I'm just going to do it here. And then we're going to do some multiple choice questions. The graph above shows the market for a good that is subject to a period of tax. The letter in the graph is the areas. Use the labeling on the graph. Identify each of the following: the price and quantity before the tax. Well, we go to our original supply curve. We're going to go straight to the left. That shows our PE. Our original price was $12, and our original quantity was 100. Stupid simple. The area representing the consumer surplus before the tax. Remember, it's everything above the price, but below the demand curve. So A, B, C, F, I think that is. That's what happens when you start drawing all over things. A, B, C, F. All right, so that's the consumer surplus. That we know that, right? That's that triangle right there. ABCF is what they're looking for. The area representing the producer surplus, well, that's everything below the price but above the supply, so it's just DGE. Easy enough. We're going to skip B. We'll come back to B in a second. Because this is kind of like our basic understandings, these things here. You should just know how to find this easily. This one takes a little bit more of a explanation. The price received by the seller. So I'm going to go back in here and I'm going to get rid of some of this stuff. Again, we should always recognize that this is the new price after the tax, right? Identify each of the following after the imposition of the tax. And people go, what's an imposition? It's just the idea that the tax has been applied to this good, so now the government's demanding their cash. It's going to jack the price up to $13. Originally, the price had been $12. Now it goes up to $13. This is the price the buyer would pay, or maybe price the buyer would pay. And then we're going to go straight down to find that QT. Let's call it QT right there. Quantity of the after the tax. Again, the vertical distance anywhere between these two supply curves represents the amount of the tax. So I just need to come to this new price the buyer pays. I'm going to go straight down. I hit that new supply curve. I bounce to the left. The $11 is what the seller would receive or put in his pocket. The buyer pays $13. The tax is $2. So obviously the seller would put $11 in his pocket. Can we see what's going on here? The price the buyer pays, here's the tax, and the $11 per unit is what would go to the seller. Now again, I've always found that language really strange. The net price received by the seller. It's just what the seller puts in his pocket. I think that's all we're looking for there. Okay. The amount of the tax revenue, well, we know the tax was $2 because we can see that. They don't tell us that. We can see that the price, that vertical distance between 13 and 11 is $2. So we know the tax was $2. We also know they sold 80 units of it. The government gets $2 per unit, so it's just 2 times 80, right? So our government revenue is $160. I think we can see that easy enough. The area representing the consumer surplus after the tax, right? Don't forget that. After the tax is just A, everything above the price, below demand. So A. Area representing deadweight loss, right? We used to get 100 units of this due to the tax. Less is sold because it's more expensive. So F and G is that loss of consumer and producer surplus. F and G would be the deadweight loss there. That was fast, but you could slow it down, stop it, think about it, go back. They listened to it a couple times. These you can do really quickly once you've done all of the FRQs. Let's see if we can answer B. Assume that the tax is now imposed based on the graph. Does the price paid by the buyer rise by the full amount of the tax? Well, you and I know that the price originally was $12 and it only went up to $13. So the price went up by $1, but you and I know the tax is $2. Well, Charles, how do we know that? I've said it. The vertical distance between the two supply curves is the amount of tax. So the price was 12, it went up to 13. The price only went up by $1, but the tax is $2. So assume the tax is imposed based on the graph. Does the price paid by the buyer rise by the full $2 of the tax? No, it doesn't. That's going to get you 1 point. And then the explanation on all of these FRQs is another point, and you want that other point for explaining. This just means why doesn't think of explain as to why, right? Why doesn't the price rise by the full amount of the tax? And if you had studied your elasticity, the only time that the buyer has to pay all of the tax is if the demand is perfectly inelastic. If the demand is perfectly inelastic and there's a tax, the supply would shift to the left. The price would go up by the full $2 of the tax. The seller would put that amount in his pocket. So the only time, and this is about elasticity, and that's why this section's a little tricky, you have to recognize the only time that we would say that the buyer pays the full amount of the tax is when demand is perfectly inelastic, right? I think you could also get away with probably just saying that demand is elastic, which if it's relatively elastic, it can't be perfectly inelastic. So I would say that it's relatively elastic, therefore they have to split the tax. The producer cannot charge the whole amount of the tax or push all of that tax onto the consumer. All right, that was a little winded, but I think you got the point. Let's look at how this has been tested on AP exams. 18, the government is considering imposing a 3% tax on either good A or good B. In order to generate the largest revenue, the tax should be imposed on the good for which? Well, think about it like this. If demand was let's just say if demand was elastic, people will stop buying the good, right? And if the demand was super elastic, if the price goes up, nobody will buy this good anymore, right? So The idea here is that the government, and the government has done this in a number of cities where they raise the tax on something and they expect to make a whole bunch of extra revenue. And then people stop using the good. They stop riding the buses, they stop riding the subway, they find other ways to get to work. So the understanding is for the government to guarantee itself that it's going to get that 3% tax and people are still going to keep buying the good, we would have to have a relatively inelastic demand. Now, I guess if we probably said if we wanted the largest revenue, we would probably want the demand to be perfectly inelastic. If it was perfectly inelastic, demand is straight up and down. People are still going to buy the same no matter what the price. So even if you put a $3 tax on it, they don't lose any whatever quantity there. People are going to still buy it. So if it was perfectly inelastic, that would give us the biggest revenue because that quantity obviously doesn't change and you're charging all of that 3%. I hope that makes sense. There's a few elasticity questions you should have done by now that would help you on that whole perfectly, relatively elastic and inelastic. All right, if the market demand for a good is inelastic, now this is very careful that we have to read these carefully. The market demand is inelastic and the supply is elastic. I like it. Which of the following is true when there's an increase in the sales tax? Now, this is what we call tax incidence. It's the idea is who's going to pay this tax. Now, we did it already, but we should be able to recognize how you could figure this out fairly quickly. Now, you should know that, and I'm just going to give you a tip here, is that whoever has the most inelastic curve will pay most of the tax. So I'm going to say that again. Whoever is the most inelastic curve will pay most of the tax. So here demand is more inelastic. So that implies that consumers are going to pay most of the tax. I could have drawn this if I would have, maybe I read that backwards, right? So maybe I would have done a demand curve like this and a supply curve more, that's terrible. I can't live with that. Like I had a stroke or something. The supply curve was more inelastic. In this situation, if supply is more inelastic, right? If supply is more inelastic, obviously the producer is going to have to pay most of the tax, right? So the producer would pay most of the tax. And I'm going to do this real quickly just so you can see this. You should be able to see this in your head. But if this is the supply, we're going to do this. We're going to shift supply to the left. There's a tax, right? Tax shift supply to the left. We got a new price that the buyer pays. Here's the price that the buyer pays. Here's the new quantity. Let's call it QT. Here's the old price. There's the old quantity. Let's call it QE. Now, to find the amount the seller would put in his pocket, we go straight down till we hit the lower supply curve. We bounce to the left. That kind of went down there for a reason. That's what the seller would put in his pocket. All of that's government revenue. But look at this. If we were to find the old equilibrium point, let's do it. Here's the old equilibrium point. If we go straight across here, what we can see clearly is that out of this tax wedge or government revenue area, the consumer section of it is huge. Consumers tax. The producer would only pay that amount of the tax. So because demand, and the way we explain this is because demand is more inelastic, right? Consumers won't walk away from this good, so they're going to end up, the producer can push all that tax onto the consumer and make them pay it. Because they won't walk away when the price goes up, the producer will just charge them more of the tax. So inelastic demand, the more inelastic, the more consumers pay. Obviously, if we did this over here, let's play the same game with a supply curve that's more inelastic and demand is more elastic. Well, here's our new price that the buyer would pay after the tax. This might be a little harder to do because of the way the curves are. This is the quantity that was originally produced, and after the tax, obviously, people want less of this good. I can show what the seller puts in his pocket by coming the vertical distance between the two supply curves. I bounce to the left. This is what the seller would receive or put in his pocket. This is all the government's wedge, right? That's all government revenue, tax wedge. I go to the old equilibrium point, and I go straight across. I recognize that this lower area, this is what the producer would pay, or his percentage of the tax. This is what the consumer would pay, or his small percentage of the tax. When demand is elastic, if that producer tried to raise the price, people are going to just stop buying it. So he has to eat some of that tax, or he's not going to make any money. He's willing to eat that. He can't push it on the consumer, or his total revenues would go down. Anyway, you should have this in your head. Whoever has the most inelastic curve is who produces the most, or who pays the most of the tax. I think that said that right. 22. After the government imposes a 20-cent per gallon tax, the price of a gallon of gasoline increases from $1 to $1.15. Now, we should be able to recognize that if the tax was 20 cents, and that's not a cent. Anyway, I've been doing Euro stuff. If the government imposes 20% per gallon tax and the price actually went up by 15 cents, you should be able to recognize that if the price went up by 15 cents, that implies that consumers are obviously paying 15 cents more. They're eating that amount of the tax, and that the producer is having to pay the other 5 cents, right? So the whole amount of the tax was 20 cents. But the price of the good went up by 15. We can see that. Therefore, the producer had to pay the other 5 cents. So we know that consumers bear not the entire. Consumers and producers share it equally. No, they don't. Consumers bear most. Yes, they do. But not all. Producers have to pay some of that tax. The government's going to get its money no matter what. I'm sorry this is so tiny. I thought I could have got this a little bit clearer. For some reason, it wasn't working very well. But this is 2012. Micro. Notice there's no macro. Indirect. I mean, this is a micro concept. So if I'm looking at this, the first thing I'm going to do is I'm going to kind of run through all of this myself and know where everything is. I know that's the original equilibrium. The price went up to 1045, right? Do we know what the tax is? Yeah, they don't tell us what the tax is, but I know the vertical distance between these two curves is the tax, that vertical distance right there. So I know it went from 1045 to 945. I know the tax had to be $1. I can see that, right? Could have also done it here if I'd wanted to. 11 down to 10. From 11 vertical distance, $1. The tax is $1. The price only went up by 45 cents. So what I know is that the consumer is going to pay 45 cents. The producer's got to pay 15 cents. Let's see if we can answer that. Again, I'd go to where the new equilibrium point, this is the price paid by the buyer. I come straight down till I hit that lower supply curve and bounce to the left. This is what the seller would receive or put in his pocket. All right, let's see if we can answer this. What is the price paid by consumers and the net price received by producers after the tax? Well, we know consumers pay $10.45. There's 2 of those, and the seller would receive $9.45. Here it is, easy enough. According to the diagram, what is the dollar amount of the tax? You and I already figured it out. The vertical distance, it's $1. Easy, easy, easy. All right, 48. Suppose that the market supply curve for shoes is upward sloping. Don't let that confuse you. I know the College Board loves to throw this kind of upward sloping thing up. That's your supply curve. It's always upward sloping, unless it's perfectly elastic or inelastic, which we don't have to worry about. The market demand curve is downward sloping. Well, most of the time it is, absolutely. How will the imposition of a sales tax on shoes affect the consumer surplus, producer surplus, and the total surplus? Well, let me give you a little hint here. If there's a tax, S plus tax, right? We know there's a new price the buyer pays. We know that there's a new quantity, Q plus tax. This is the price the buyer pays. We come straight down. We hit the lower supply curve. We bounce to the left. This is what the seller receives or puts in his pocket. I know that triangle right there is a loss of consumer and producer surplus. That's all deadweight loss. So if there's deadweight loss, doesn't consumer surplus have to go down? As the price goes up, we know as the price goes up, consumer surplus has to go down. So consumer surplus had to decrease. There's 3 of those, right? But we also know that we lost, deadweight loss shows producer and consumer surplus, right? So we've lost some producer surplus. So we would also say that decreases. That's an increase. We get rid of that. We can get rid of that. We can get rid of that. Oh, we've already answered answer that question. Obviously, these two together equal total surplus. So if these decrease, this has to decrease. There's not a lot of multiple choice questions, one a year, right? At the most, maybe two from 2012. But you should go back and do every FRQ there is on these so that you know them well. All right, guys, be safe. That was pretty quick, a little scattered, but keep working hard. If you need my help, Wise Ant, you're just looking for Charles W. If not, Wise Ant's got a lovely group of people on there to help, or just find somebody to help if your teacher's not doing it right. All right, keep working hard. Be safe. Take care.